Hello, good evening students. In the last class in accountancy, we have discussed the receipts and payment account concept and the income and expenditure concept. The two concepts, it was very clearly explained in my previous video. As I have told in the last class, I told that I will be explaining the fund-based system. That's what I am going to explain today, fund-based system. It's called fund-based accounting. To do the full-fledged problem, that's the preparation of income and expenditure and balance sheet. That is our motto. We have to, in the CBSE problem, you will be asked to prepare the income and expenditure account and balance sheet. So to prepare the income and expenditure account and balance sheet, directly I am not going to demonstrate the problem. Before demonstrating the problem, two important concepts you have to understand. That is, number one is fund-based accounting. Another one is cost of consumable. This fund-based accounting, you see, what do you mean by fund? Fund means money. So the money. So the fund is nothing but a simple meaning the money. But in the not-for-profit organization, there is two types of fund. One is the general fund. One is the general fund. Another one is the specific fund. Another one is the specific fund. The general fund is otherwise called as the capital fund. General fund is otherwise called as the capital fund. Okay. These two funds are flowing into the business. Business I should not use, flowing into the organization. That's called not-for-profit organization. This general fund, how it flows? Very simple. The members are contributing the subscription, and the members are, as well as the public, are giving a general donation, small amount they give. Like that, the money keeps on coming. So in the income and expenditure, the income side, all the inflow will be recorded. That's called subscription and other day-to-day income. From that income, all the routine expenses will be subtracted. Finally, what you will be getting? We will be getting the word that surplus we have to use, because the profit should not be used. The surplus we will be getting. The surplus amount is nothing but general fund. Okay. The meaning of general fund is the general fund from which we can spend the day-to-day expenses. Only general fund amount can be utilized for day-to-day expenses like revenue expenditure of the not-for-profit organization. So the day-to-day expenses of the not-for-profit organization will be taken from the general fund. So the general fund means, that is the meaning, the day-to-day expenses will be met out from the money which is called as the general fund. It can be used for any day-to-day purpose. Another fund is called as another money is called as the specific fund. The specific fund means when that fund comes to the organization, it will be clearly earmarked that that money should be utilized for particular purpose. For example, building fund, match fund, prize fund. Like that, many specific fund will be there. The difference between the general fund and the specific fund is The general fund money can be utilized for the day-to-day expenses of the not-for-profit organization, any expenses, but the specific fund amount should be utilized only for the purpose for which it has been collected. So, whether it is a general fund or it is a specific fund, if fund means that will be a liability. All the funds, there is only two funds. Number one is general fund or capital fund. Number two is specific fund. This both the fund will be recorded in the liability side of the balance sheet. If you ask the question why, means last year when we were preparing the trading and profit and loss account, finally the profit where it went to which statement, the profit has been transferred to where? The profit was transferred to the balance sheet liability side, it has been added with the capital. Like that, the surplus we have got from the income and expenditure account, that will be added with the capital fund. Okay? So the capital fund is a liability, I told. The capital fund will be appearing in the liability side. Let us take example of 5 lakhs. 5 lakhs rupees. In addition to that, specific fund. The specific fund also coming under the liability side of the balance sheet, that is the left hand side of the balance sheet. Take any fund, for example, there is a match fund. It's a match fund. Match fund, let us keep 6 lakhs rupees. Okay, match fund, let us keep 6 lakhs rupees. Here, why I selected this fund-based accounting, this time has come, listen very carefully. Whatever the income comes in respect of the specific fund. Here I have taken match fund. Match fund, some income may come, some expenses may be incurred. Income means donation for match fund. It will be coming. Then prices, match we will be conducting, match expenses will be there. That match expenses has to be subtracted from the match fund. Ultimately, what I want to say is, whatever the income the not-for-profit organization receives in connection with a particular fund, it has to be added with the particular fund, the respective fund. If any expenses takes place in connection with the purpose, that is for the match, for conducting the match, for printing the tickets for the match, for giving rent to the ground, is all these in connection with the match, conducting the match, that expenses has to be subtracted from the particular fund. Listen carefully. For example, I told we have received the donations for match fund. For example, we have received the donation for 2 lakhs. So we have to add the donation. Ultimately, it will become 8 lakhs. Okay? Then some expenses we may perform. Expenses like for conducting the match. Generally, you can say that match expenses. The match expenses, money will be coming or going out? It will be going out. That's why I am subtracting the match expenses, it may be 5 lakhs. Balance money 3 lakhs. So, any income has to be added to the particular fund, any expenses should be subtracted from that fund. This income and this expenses will never be recorded in the income and expenditure account. Income and expenditure account, income side, you should never record that because when there is a fund, you should be very careful. When there is a fund, income in connection with that fund should be added. The expenses in connection with that fund should be subtracted. That's why I have here subtracted. One more thing I will be explaining to you. Here there is a capital fund. Capital fund here written is 5 lakhs. Any fund, if you keep in hand, it won't give you any benefit. For example, you are having 1 lakh rupees in your hand. If you keep in your hand, that will not give any benefit to you. Simply that 1 lakh will be remaining as 1 lakh. Instead, that 1 lakh, if you are investing outside, you can invest in the bank, like bank deposit, fixed deposit. If you invest, what you will be getting? You will be getting the interest from the bank. That is why no organization generally will not be liking to keep any fund amount idle in the organization. That's why this fund equal to that here cash balance is there with us. Fund 5 lakh is there means here cash will be there for 5 lakhs. Equal liability and assets. Let us imagine the capital fund 5 lakhs is there means cash will be there for 5 lakhs. Okay. Now this 5 lakhs, if you keep it in hand in the organization, there is no benefit. That's why this cash we are depositing or investing. Generally we use the word investment. If you put the money in outside sources, anywhere if you put the money, you can put it in the bank, or you might have purchased a share, or you might have purchased a debenture, or any investment if you buy, that is called as the capital fund investment. Capital fund investment 5 lakhs. This capital fund is otherwise called as the general fund. So it can be interchangeably, we can use the words like either it is a capital fund or it is a general fund. So the general fund investment here 5 lakhs. We have capital fund 5 lakhs. Here the capital fund investment 5 lakhs. Okay. I told why we are investing. We are investing because we'll be getting some income. Let us imagine that this capital fund investment or general fund investment will be invested for 10% interest. So every year you will be getting 10%. So 10% of 5 lakh, 10 by 100 into 5 lakhs. You will be getting 50,000 rupees every year as an interest. That interest, if you are receiving that money without any hesitation, you add with that fund. Because I have already told that any income related to that fund. This is an income. How that income has come? This fund has been, this capital fund has been invested in the investment in the market. 5 lakh rupees we have invested. How much Interest we have got the interest 50,000 rupees. This 50,000, I was going to do a mistake. I am accepting this 50,000 should not be added with the specific fund, because this is a general fund. General fund income, how you can add with the specific fund? That's why it cannot be added. Then where you will be recording? This 50,000 will be recorded in the income and expenditure account, income side. Listen carefully. First I was going to add, by mistakenly I thought that this is the income from the specific fund. That's why I was about to add that, but it should not be added with the specific fund. This general fund income, that is, this is called interest on general fund investment, should not be added with the specific fund. It will be recorded in the income and expenditure income side. Come here, match fund. Match fund, how much is there? 6 lakhs is there. This match fund also we can invest. So if you are investing the match fund investment 6 lakhs. Okay. This also let us assume 10%. So 10 by 100 into 6 lakh is 60,000 rupees. 60,000 rupees is the income we have got from match fund investment. This match fund investment we have done due to this match fund. So the income is related to the specific fund. That's why this income should be added with the specific fund. Interest on match fund investment 60,000 you have to add. The total will be here 3,60,000 will come here. So listen students, now I am coming to the conclusion that any income arising from the general fund investment, this is 50,000, should be recorded in the income and expenditure income side. But any income arising from the specific fund, that's called this match fund investment, this income should be added with the specific fund only. It should not be recorded in the income and expenditure account. This is the fund-based accounting concept. Very simple concept. Number one, all the funds will be recorded in the liability side of the balance sheet. Number one is general fund, liability side of the balance sheet. Number two is specific fund, liability side of the balance sheet. It has to be recorded, no doubt. But the investment will be automatically asset. General fund investment, it will be invested, general fund investment. If general fund is invested means general fund investment. Here specific fund invested means match fund investment. The investment will be coming to the asset side. Any income coming in respect of the general fund should not be either added with the general fund or should not be added with the specific fund. This income will have no place in the liability side. It will be recorded only in the income side of the income and expenditure. Clear? The next point, in case of the specific fund, any income related to the specific fund, like donation for match fund should be added, match expenses should be deducted, then if any interest comes from the match fund investment, that has to be added with the specific fund. By that way it will be recorded here. Then, why I have given this separate thing is, you should be very careful regarding only one fund like building fund. Regarding the building fund will be a liability side, you know very well. Building fund 10 lakhs rupees are there. Building fund investment here 10 lakhs. If any income comes like donation for building fund 5 lakhs, total 15 lakhs. Then plus income from the building fund investment, it has to be added. Interest on building fund investment, maybe this 10 lakhs, 10% let us keep 1 lakh rupees. So 1 lakh will be added, 16 lakh. And next point, you listen very carefully. We may construct the building. So when we are constructing the building, construction expenses to be deducted. Maybe construction expenses maybe 8 lakhs. So 16 minus 8 lakhs will be. In case of a building, when you are constructing a building, that money is not going out, that money has been transformed in the form of another asset called building. The building will come in the asset side. This 8 lakhs will be again appearing in the asset side. This was not happening in this type of match fund. Only this is happening in case of the building fund. Because in case of the building fund, whatever expenses you spend, if the construction is taking place, that construction after that, it will be converted into asset. That asset will be appearing in the asset side of the balance sheet. Now one question will be there. Here you have deducted 8 lakhs. So building is appearing 8 lakhs. When from this fund, whatever the amount we are subtracting, this 8 lakhs, don't forget to add with the general fund. General fund amount, this 8 lakhs to be added. That is called transferred from building fund. This 8 lakhs should be again added here. Okay. So in case of a building only, the same thing, building fund, donation for building fund should be added. Then interest on investment, building fund investment should be added. If any expenses takes place like construction expenses, this construction expenses should be deducted and the balance will be recorded. These expenses equal to that, you will be getting a new asset, building will be appearing here. Then this fund will be again transferred to the general fund. It has to be added with the general fund. That is the only thing, students. I hope that you may not be having any doubt. Even if you have any doubt regarding the fund-based accounting, you can ask me over phone or you can interact with the Zoom classroom. We will be coming to the Zoom meeting. If you have any doubt, you can ask the student. Thank you very much. Thank you.